Hey, what's happening? Thank you for joining today. This is Jerry with Wealth Dynamics, and today I am talking to you about why you should use life insurance as part of your wealth creation strategy. Now, what is wealth? Wealth is the ability to treat money like oxygen. It's abundance in all areas of life. It's the opposite of poverty. Poverty is scarcity in any single area, and the only way to build wealth is to stop trading time for money. Now, what that means is you need to have passive income being generated by assets that buy your time back for you so that you no longer have to work for money. Now, you can do one of two things here. You can negate that and just not do anything, or you can try and get there. And if you try and get there, you have to save up money to put into these deals that pay you passive income. Now, if you're putting money away for these deals, A, you need 50 to 100K to get into a good one. B, you can put money in the bank, or you can put money in life insurance. Now, when you're saving in a bank, you get absolutely nothing. Think about this. You put the money in the bank, other than liquidity, what do they give you? Let's say you have 100 grand and you're like, man, I'm working this up to 250 so I can do this real estate deal. When you go from 100 to 250, they might give you $200 in interest. And that's only if the money stays there the entire time. If the money doesn't stay there, they're not going to pay you interest. So you don't even get the interest. You just basically get a place to put money. I could do that with my pocket. I could do that with a safe. What purpose is there other than storing money there? So the alternative is life insurance. And I say life insurance and you're like, oh, life insurance? But then I don't know what to do. It's just life insurance. So check this out. Get rid of the concept that is life insurance. Quit thinking about death benefits and insurances. Just think about if you were storing money somewhere. You could store money somewhere where all you have is liquidity and they pay you nothing, or you could store money somewhere where you have the same liquidity and they pay you 6 to 8%. And on that 6 to 8%, when you withdraw the money to go do your real estate deal, they're still going to keep paying you that 6 to 8%. Okay, think about this again. You go to the bank, you put 100 grand in the bank, they might give you 0.10% interest, but not if you take the money out. If you take the money out, they don't give you anything. You put it in the life insurance instead, they're going to pay you a 6 to 8% dividend, and also if you take the money out to go do a deal with it, they're going to keep paying you the money even though it's not there. Like, consider going to a bank and giving them 100 grand, withdrawing the 100 grand, and then looking at your balance and your statement and realizing that they kept paying you interest even though the money wasn't there. That's what life insurance is doing for you. Okay, now you're thinking immediately, well, what about the cash value, and I've got to pay a loan, and there's the interest thing that goes on. How do I handle that? Okay, again, just simplify the whole deal. When you put money into an account and it grows and you withdraw it, that is called a taxable event. When you put money into an account and it grows, and instead of withdrawing it, you borrow against it, that is called a non-taxable event. Okay, would you rather pay taxes or not pay taxes? Now, you do pay interest, but get this, as a policyholder, if you set the policy up right, you're also a shareholder in the company. So you're paying interest to a company that you're a partial owner of, and the profitability of the company reflects in you getting a higher dividend. Okay, so again, simplify. Would you rather pay taxes to the IRS, or would you rather pay interest to a company that you profit from? Very simple. Now, you're also caught up on the death benefit. But Jerry, there's a death benefit. I don't want to buy insurance because insurance is a scam and I don't know anything. Just forget about the death benefit. Like, at the end of the day, the policy pays for that itself. You're not paying out of pocket for it. It will be there. It will grow. It is tax-free. Don't even worry about it. When you're 90-something years old, somebody in your life is going to inherit a bunch of $1 million tax-free because you had a death benefit. That's about the extent of how far that goes. You never buy a policy because it has a death benefit. If you're buying life insurance because you feel guilty about what will happen when your family dies, or when you die and your family's left over, what that really means is you suck at finances right now. It doesn't mean you need life insurance. It means you need to get your money right so that you don't feel guilty when you think about what happens when these people I love inherit what I've been doing with my money my whole life. It has nothing to do with life insurance. The life insurance is a savings vehicle, okay? So what I want to do is I'm going to post an article in the comments for you guys so that you can check this out. Go ahead and read through it. And the bottom line is this. You can either do what everybody else in America is doing right now, which is earning income, working hard, and then giving it to the IRS, to Wall Street, and to central banks so that they can get rich off it at your expense. Or you can do it my way. If you're ready to check out my way, I want you to read that article, click here bottom link at the bottom of the link at the end of that article, and we can set up a call and go over some more information. Thank you for watching. Like, share, subscribe. Have a fantastic day.